You like that one? I like that one. That's good.
Hey guys, welcome back to another week of the Educated Homebuyer Live. This is where Josh and I answer your home buying questions, your mortgage questions to help you become the educated homebuyer. So as many of you guys know, I was gone last week. I was dealing with a family emergency. Not going to go in a lot of detail here. Those that follow me on social media have a better idea of what happened. But, you know, the most important person in my life was affected. And for the last week, I've basically been spending the night in the hospital. And good news is she's home today and things are looking better. So, you know, I know a lot of you guys have reached out with prayers and support and positivity, and I am very, very grateful for that. And yeah, so with that said, guys, let's start talking the reason that you're here. So Josh, this week, job openings actually came out today. In labor, we had ISM. The ISM actually moved the market in the direction that we want to see it, which is, you know, the 10-year coming down a little bit, rates improving a little bit. Then we had the Fed come out, and the Fed more or less confirmed what we thought was going to happen out there, which is no rate hike for the foreseeable future. I think the idea, and we can elaborate on this, is that this is probably the end of the current policy with regards to hiking rates, and we're probably going to be in this higher for longer phase, right? No reductions for an extended period of time. So with that, Josh, I know I kind of just, you know, got long-winded there, but, you know, good to see you again here on camera, and appreciate you holding down the fort.
Well, I had no headphones on last week because there was no one to listen to. So it was weird. I tried to do it again. I said, wait, I can't hear Jeb. So I had to grab them. So we are happy to have you back. It's fun to get to talk and bloviate for an hour, but it's more fun to have a conversation. So glad to have you back.
Absolutely. And we're trying to do this without, you know, we've shut everything down. You know, another friend of mine who is a real estate agent, YouTuber, reached out to me and said, hey, try this when you're live streaming. This is what they told us to do. So we're trying that method tonight with both of us on here to see if we can go without freezing. If we can, then clearly, you know, we're the issue here and it's not the internet, but we're still going to blame the internet.
Error, operator error.
Either way, we're going to blame the internet. So we're starting out with a super chat in here from Patrick. Patrick, I appreciate you very much. We're going to get to your question here in just a minute, but we're going to dive into some data to start. So Josh, you kind of rearranged some slides here, so I'm not sure exactly where we're starting on this whole thing. But
no, just go back to the beginning.
All right, we're going to go start at the beginning.
All right, at your stuff. Now,
all right, and for you, those that are new to the show, you know, there's going to be a slide deck in the description. We'll put a link to it so you can go to it, look at the slides if you're new to this. And so just, you know, we're going to go through this audio. Again, if you're not able to see this, you know, we try to make it as visual as possible just so you can understand what's going on. So we always start each week by looking at inventory. Inventory hasn't peaked yet, which isn't really a surprise based on where rates are. You know, typically you would already have the seasonal peak in inventory sometime late August, and you would start to decline through the rest of the year. This year's a little bit different. 8% interest rates. Inventory isn't really new. It's not new listings coming to the market. It's the problem. It's just homes that are on the market are sitting longer and just less really going into escrow, which creates a problem. But we've surpassed 2020 levels, but we're still sitting under 2022, just over 562,000 single-family homes nationwide. Really, really low levels still, but higher, you know, than we were in 2020, just below last year. So this is, again, that little historical chart going back. We used to show it going all the way back to 2016, 2015. They've changed the chart, as I mentioned before, but still kind of shows where we were prior to the pandemic and where we are now. You know, seasonally, we should be hitting a peak here real soon, just because things do tail off, even with high rates, as we start to get into that holiday season. And we're likely to see that here in the next couple of weeks. National single-family new listings. So this is the new listings data that I'm talking about. And how do you know, you know, we kind of mentioned this last week. How do you know that Airbnbs coming to the market aren't a problem, foreclosures aren't a problem, and all of these other, you know, things, shadow inventory is not a problem at the moment? It's because you're not seeing a big spike in new listings data, right? So new listings data is still trailing sideways down across the board. If you were to see a major problem in the United States with regards to inventory, this is the chart you're going to see it on first. This is the chart that's going to spike. You're not seeing that at this time. Not likely to see it at this time. So inventory week over week went from 554 to 562, about 8,200 properties on the market. This time last year, we were sitting at 578. Peak or actually the bottom back in 2022 was 240, and we're currently sitting at the peak at the moment. Contracts, pendings, we're looking really, really close with new pending sales to where we were this time last year, which is we've always been a little bit below. Right now, we're more or less sitting at the same pace. And that's a bit surprising, Josh, because rates are at 8% and you're still seeing pendings go under contract. I don't know if we're surprised, but I'm a bit surprised that there is as much activity as there is at the moment because of that.
A little bit surprised, but I would also say we wouldn't have expected to see it quite this fast because it wasn't just a steady grind upwards. It was until about 7.5. That spike from 7.5 to 8 was fast. So we're going to go into rates and we'll see that it looks positive that those were just a temporary blip. But if those had continued for several months, I think you would see it have a bigger impact just because of the affordability levels that we don't have enough people at 8% to continue pushing prices higher, not enough able demand.
Agreed. Median home price is coming down a little bit, year over year. I mean, I don't know. What does it say? We're at 434 here. Median price of new listings declining a little bit. Overall, I mean, to be expected. Part of it's seasonal. A lot of it has to do with rates and just the lack of demand out there in the market.
I would love, Jeb, someone to explain to us why median price would be seasonal. It clearly is. Look at that chart. Median price
for
gets the second half of every year. So it clearly is. But tell me the mechanism. Why? Why are buyers in December wanting cheaper homes than people that buy in December?
Maybe it's the people that are maybe it's the people that are at the lower end of the price scale continue to look through the entire year versus those that are at the higher end. That's the only thing I can think of, right? The people that are at the higher end of the price scale have the opportunity to take a couple of months off and say, I'm not dealing with this during the holidays. I don't need to deal with this. Whereas others might. I mean, again, clearly a guess, but it's the only thing I can make sense of there. Price decreases. So currently sitting at about 38, 39% compared to 43% last year. Somewhat surprising, again, just based on where rates are, where activity is in the market. You think you would see more price declines out there, but you're just not. And that's the reason that, again, the market is somewhat stable. A lot of it has to do with just the lack of inventory in the market to begin with. There's just not a lot of supply. So you're coming from a really low level to start with. And that's part of the problem. And that's something we're going to be dealing with for some time. So Josh, this past week, we got FHFA, Case-Shiller, CoreLogic, everybody coming out with their home price index, their month over month numbers, year over year numbers. And that's what we're looking at here.
Yeah. And rather than showing 14 different charts, they're all slightly different in the way they calculate the data that they're looking at, but they're all telling the same story. We got year over year figures positive across all 5 of them. The 2023 pace just says, hey, year to date, but that's not really a fair number because it's reasonable to think here, October, November, December, we're getting October figures. November and December will trend down a little bit. Kind of wanted to just say it wouldn't be unexpected that December, January, possibly even February are flat or slightly negative. There's a seasonal component to it, just like median prices, just like listing supply of homes for sale decrease. When we see a market that's just not on fire like it was in 21 and 22 or 2020 and 21, you're not necessarily going to see prices just continue to trend up. But the momentum appears to tell us that when we get September info from all of them, when we get October, that they're likely to be up, not quite as hot as they were the last few months.
Yeah, and there's a chance that come January, come February, you actually see some year over year declines just based on how these numbers are calculated or flat. Pretty much across the board. But in how these calculate, it's a bit weird and it would be complicated to go through each one of these. But for the most part, I think most markets have a pretty good idea. You're not seeing prices crash, but things aren't going bananas either.
And remembering with that, Jeb, all of those are national numbers. So just remember,
exactly.
Some markets have done much better. Some markets are down, and the accompanying articles to those would show you there definitely are markets that are down. This one I thought was important to take a look at. This is Affordability Price Index. This is our guy over the Calculated Risk blog. Some of the stuff is free. Some of it's on Substack behind a paywall, but really good data. He's just a neutral observer. He doesn't really have an angle. He's just analyzing the data. I threw the two green lines on there to show that from where we peaked, actually, the first thing I wanted to show, Jeb, where we are in terms of affordability is way better than 1982. We talked about that a little bit. Well, obviously, rates were 18%. Home prices were more manageable, but rates were way beyond double what they are right now. But what we saw all the way through the next 40 years was rates pretty much trended down. So the lower green line I put in there was just showing through 2001, before we had the big run up, affordability had gone nowhere but down. Then we had a run up and then a little correction in prices. So the prices there, interest rates were going down through this whole time frame, but prices took affordability up to a high level. And now we are above that because we're getting the double whammy of both. Prices are at a peak and interest rates are at a near-term peak. So we'll go into that a little further in the show, but I do think affordability will normalize, whatever that means. I don't know that we're going to get back down to 100 anytime soon, but a drop below that 140 level would be reasonable as we see interest rates normalize. This one here, Jeb, I just threw it in here. We talk a lot about consider your sources, know who you're talking to. This kind of boggled my mind because these guys they're somewhat perma bears, but I love reading their stuff because they're smart, thoughtful analysis. But the first thing in there, U.S. new home sales rose 12.3% month over month to 759,000 in September, up from -8 in August. So consensus belief above the 680,000 expected. Their reaction to this is home builders cut prices to drive sales. And they use their evidence is median -12% year over year. They're not cutting prices on homes that are for sale. We've gone through it. They are buying down people's interest rates, so they're cutting their profitability. That median is coming down because they are selling homes with less upgrades and they are selling smaller homes. They've adjusted what they're building over the last year and how highly they're speccing it out. So just consider, even very good, very trusted, these guys don't have an angle. There's nothing that they're trying to spin there. But because they're perma bears, they look at that and they see bearish news there. This one, I think I actually got the damn thing out of order, but we've talked about our U.S. government and the fact that we have that's maturing. We have, 90-day treasuries. We've got 1 year, 2 year, 5 year, 7, 10, all the way out to 30 years. And what this shows is corporate debt. Companies, the same thing. Many of them, when rates were really low, were issuing short-term debt. Some of them were doing things like just buying back shares to push up their share prices. Others were investing a little more wisely in their businesses. But this shows you over the next few years, if rates stay this high, it's not just a problem for the US government, it's going to be a problem for corporations, and necessarily they're the ones that are less solid financially. So this one, I don't know if you saw this one this week, Jeb, but Stanley Druckenmiller criticizes Janet Yellen for not locking in long-term interest rates, calls it the biggest blunder in Treasury history. Because we like to be nonpartisan here, I will follow up, and you see the sub-headline there, Mnuchin under Trump may have missed the same chance. Both Mnuchin and Yellen had the opportunity to lock in rates for up to 30 years in the low to mid 1% range, and we wouldn't be having this issue. But they made the decision to continue buying shorter dated treasuries because they could get a 0.25% lower rate on it at that time. And if rates stay elevated like this, Druckenmiller is 100% correct that this will be the greatest blunder in the history of the Treasury. And he actually used the analogy that every homeowner in the United States saw these low rates and said, hey, I'm going to run out and get a new 30-year fix. No one was saying, hey, what's the rate on a 2-year ARM? And that's essentially what our government did. So not the smartest move. And both administrations boned that one. So whichever side you're on, you both got it wrong. This I thought was interesting, Jeb, showing we had the big dip in GDP during COVID. But if you look, this was their projection, the Congressional Budget Office's projections in January of 2020. So that's not a projection now. That's where they projected things. So they pretty much had it right if we had not seen COVID. And if you look at it, that's showing in dollar amount. It's not showing the annual increases. So from that perspective, we're kind of where we're supposed to be. So the big dip made us lead to big high numbers, and people going, people understood that during COVID, oh, those aren't real numbers. Those are COVID impacted numbers. But now we're like 2 years post COVID, and they're like, oh, the economy is doing awesome. And you're like, no, this is just stuff working its way out through the system. So wanted to throw this one here. Q3 will not be sustained. We talked, was it last week or the week before, Jeb? Super hot. First read on Q3 GDP was 4.9%. This is our base case right now, is that Q4 GDP will grow. Growth will be about 0, though the margin of error in forecast at this point in the quarter is enormous. The range of plausible outcomes is from -4 to +4. But if you look at all of this, we're likely to see something in the 0 to 2% in the fourth quarter. This is the Fed's analysis, the numbers they put out when they meet. So last meeting, the little red line is their central tendency. So they're saying for 2023, they think it'll be a little above 2. For 2024, they think it'll be below 2. But over the long run, they see it at 2%. Nothing fundamentally has changed, and we've gone through some of the reasons for that before. So this one I want to show. This is the Wall Street Journal has surveyed business and academic economists, and now less than 50% of them think we're going to have a recession. So you look at it and go, it will be interesting to see. If we say there's going to be a recession, we are correct. At some point, there's going to be a recession. So you have to put a timeline on it. But we'll see. We get to watch it over the next year. All these next charts here just kind of show, Jeb, talking about GDP. GDP's been really strong. People say, hey, soft landing, GDP's hot. Well, look at these charts. GDP at the recession start, 3%, 2%, 4%, 4.3, 1.7, 2.2, 2.16. You don't start from negative GDP and work your way into it. It works its way out over time. So this is basically showing you the markets. So what happens to the market? So this is basically, they're looking at the S&P here. And people are looking and saying, well, the S&P hasn't crashed. We can't be in a recession. Again, that's a lagging indicator. And the market lead of the recession, the market will tell us first, because the market has been ahead by 14 months, 10 months, 13 months, 11 months. And since 1980, it's been a smaller number, 8 months, 1 month, 7 months. So it's not likely to be one of these long one-year leads. But when the stock market rolls over, that's your first indication that we probably are heading towards a recession. So the actual recession dating versus market realization, again, just another way of looking at it. The blue dots were the high in the market, and the yellow is when the NBER actually called a recession. So we'll see it there first. Also here, Fed funds and the lag effect. Changes in interest rates only impact new borrowers, including those with maturing debt. So we talked about the government's going to have maturing debt. They're going to be rolling over to higher rates. Corporations going to be rolling over to higher rates. So that impact will be felt. We will not feel it in mortgage and real estate because almost no one took out adjustable rates. There's nothing rolling over. They still have those ultra low rates that are locked in for the next 30 years, unless they choose to sell, which Jeb's charts show us no one, or virtually no one, is choosing to do that. Jeb, this one, I did a little screen grab from CNBC this morning. So they had on Mark Zandi. Mark Zandi's a good economist, follows the housing market. His slide here says rates likely at a peak as economic growth is set to throttle back. So GDP decreasing, market likely to turn over, possible recession or soft landing. Rates likely already at a peak. And we saw a big rally today that we're going to go into. Rates are going to decline quickly. And when they do, they will settle in much higher than the pandemic, than pre-pandemic. So important note there, Jeb. This isn't the only person that I see that's saying, hey, when this turns, it's going to turn fast and rates will drop quickly, faster than they went up, which is not normally how it works. They generally grind their way down and then spike quickly like we've seen over the last few months. But it is important to note that no one here is saying 3% interest rates or 4% or 4.5% are coming anytime soon. You talked about this, Jeb, at the top of the show, US ADP employment change. We saw a number, 113,000 jobs. So remember, ADP only tracks private jobs, not government jobs. But the important thing to look at is just look at all of those arrows. If we look at the 12-month average was at 224,000 and we're down at 133. The 6-month average is technically 236, but that red number there, I did the average taking out the giant spike month there of 455 that no one has ever been able to make sense of. And that takes the number down to 192. The 3-month average is at 127. So definitely showing a slowing labor market. This is the JOLTS data that you referenced, Jeb. Not much movement over the last 3 months. And when we saw, what is this, back 4 months ago in June, we had that figure below 9 million. It sounds paradoxical, We want less jobs available and open because we have a tight labor market. If there's more jobs open, it means employers are not able to fill those jobs. So this, Jeb, is what we're looking at, what we've looked at so far this week. It shows you yesterday and today. This has been probably the most important economic week
for sure.
of the year. So we had the employment cost index yesterday. Then we had consumer confidence. And both of those, the reason why I put them there in yellow, employment cost index was estimated to come in at 0.9. It came in at 1.1. That's shouldn't be good for bonds, but bonds did well. Consumer confidence forecast at 100 came in at 102.6. Shouldn't be good for bonds, but the market reacted well. So today we had the ISM manufacturing. This one was in green there because it was a positive for bonds. Expected to come in at 49.4, which is contractionary, but came in much lower at 46.7. We already went through jolts. We talked about the Fed decision, but we still have two important days.
This is tomorrow and Friday.
We're going to show you guys the charts of we had a great week so far, but it's sort of like this is the heavy stuff. So tomorrow we get initial claims and continuing claims. So that's the weekly jobs report. Productivity and unit labor costs are also going to come out. So to understand why that's important, if your workforce is more productive, you can pay them more and your unit labor costs will stay under control. So if those come out hot, that could be bad. If we end up with not enough initial claims, that could be bad. And then on Friday, we have the monthly employment report and everything there, payrolls or hourly earnings, unemployment rate, average work week. So all of those components come into it. And then actually the last one there, Jeb, you and I missed it when we were looking at what's coming up earlier. The ISM non-manufacturing index, I don't know why they won't just call it what it is. The ISM services index, that has been the portion of the jobs market that has been much hotter than where the Fed wants it to be. So that will be an important one that we're going to have the next 2 days. Jeb, you guys, we'll leave this up here for a minute. You can read through it, but it was him threading the needle of basically saying, we haven't made any decisions. We're still wanting to see it trend down towards 2%. We're not convinced it's going to be there anytime soon. So basically leaving themselves open either way, but the futures markets are telling us that they do not expect any more Fed hikes. So this is the chart here that shows basically the yield on the 10-year up still near 5%. I've been started showing you guys this of just what's happened since we were here last Wednesday. So we made a run up to 498. That's the high water mark of the last week. And then as of today, we're down to about 475. So almost a 0.25% improvement in bonds. And this doesn't filter through this quickly to it, but the 30-year fixed at 7.69 as of yesterday. So that's probably as of today, close to a 0.25% better than that. So close to 7.5%, which is a big change from 8% a week and a half ago.
No, so good stuff, guys. So, tomorrow, Friday, big days in the market, that could lead to, lower, 10-year moving downward, rates improving. But here's the thing. What does that mean? It means best case, probably 0.25%, something like that. I mean, you're not going to see 0.5%, a full percent, something like that, unless the market just crap the bed type thing, at least in my opinion. I think it's again, Josh has said it several times, it's a slow grind lower. And so, but the idea, slower economic growth leads to lower rates. So, and we're headed into a slower time of the year. So not a lot's going to change for the foreseeable future, but these things are good things. If you're somebody that is, wanting to buy, wanting housing affordability to improve a little bit, these are the things you need to see.
Jeb, you pulled up your chart earlier today and you had it marked there. We have a clear path to 454. So if we're at 475 today, it's just exactly like you said. There's maybe about another 0.25% here to ring out of the market in this leg down. And remember that once you see it's kind of an abrupt move, if we went from 8 to 7.25, it doesn't just keep going down. It will consolidate that move and probably bump back up to 7.5 before making that next leg down.
And if it does go down quickly like that, then if you're on the fence, you better lock it, because there's a chance you see that bounce, right? I mean, you see that Josh said consolidation, but there's also the chance that you see that bounce before it does consolidate. So, in the opposite direction. So if you see something, say something. No, if you see something and you like it, lock it. So, all right, guys.
Don't get too aggressive just because we've had 2 or 3 good days here.
There you go. I like it. The way we have the screen set up now, I have no idea how many likes there are. Somebody says only 6 likes. Wow, 6 likes? Really? I can't see it because I had to shut down all the screens in order to not freeze here, supposedly. So if there's only 6 likes, guys, this is disappointing. But with that, Patrick started off tonight before ever coming live and giving a $10 super chat. So thank you a lot, Patrick. Really appreciate it. Says you guys were big help buying a house 2 years ago. Sold in May for good profit. Going to consolidate homes with girlfriend, I assume. Closing on new home December 1st. Girlfriend home not selling. When should we consider renting it? So here's the thing. When should you consider renting it? Are you in a position to keep both homes comfortably? If the answer is yes, with that home being rented, then why wait? Just rent it now. Why? What are you waiting on? Are you in a position where you have to sell it? Right. So look at it. Do you still qualify for that new home in December 1st without selling that home? If the answer is yes, then consider renting it. If the answer is no, then you better sell it quickly. But how much rent is it bringing in? How much is your mortgage payment? How long are you okay doing that? And that's how much money do you have tied up in that property that you don't have access to? These are all things you have to consider. Not really an easy answer. It's kind of a personal choice. Like for me, buying a new house, I had the opportunity to rent my house. There was a position there to keep it, but in looking at the numbers every month, if I rented it out, I would still be upside down based on me having to take money out of that property in order to make things work without pulling money out of stocks and equities and other things. It just financially for me, looking at that negative every month, it wasn't a huge negative, but it was about a $500, $1,000. It was more than I wanted to see at this time. So I wasn't comfortable. You got to decide if you're comfortable.
And I would say, Jeb, I think we went through this a couple of weeks back. I thought on my property out in Orange that we bought during the pandemic, renovated, I thought it was $600 to the positive. I think we're all overly optimistic. And so I went back, I looked at the expenses as I was doing the 22 taxes, kind of ran through everything. It's about 450 to the positive. So just be aggressive with your expenses, not with your income and potential net there. Be realistic with yourself when you're running those numbers.
No, good. Let's see. Rod came in with another super chat. How long does an appraisal take after signing the contract? Once it happens and it checks out, you are conditionally approved. Next, when can you lock in a rate? So funny you asked this. This is not a plant, guys. But this last week, we actually did an episode talking about appraisal versus home inspection. So on the Educated Homebuyer YouTube page, Spotify, Apple, all that stuff, if you go listen to it, we actually break down the differences, all of that good stuff to help, you understand it in a little bit more detail, kind of a 30-40 minute dive into that conversation. But this is one question, Josh, I don't know that we addressed specifically because we did talk about home inspections, but essentially the appraisal is ordered after your initial disclosures go out and get signed. Josh, so what does the time frame typically look like that from your side?
It varies by region of the country and how many appraisers they have, and not even just region of the country. So I have a deal in Nashville right now. Actually, 2 weeks ago, we ordered the appraisal. We got it back in 2 days. The appraiser ran out, inspected it, and we got it back in 2 days. Most areas that are not rural, meaning they have a number of appraisers that are there and wanting business, 5 to 7 days. And then you also talked about when can we order it. You cannot be charged for an appraisal until the full disclosures are out and acknowledged. I can pay for that as a lender for you. So we can order it, put it on my dime, and then get reimbursed at closing after everything has been disclosed to you. But that's an important timeline because think about this. Jeb, you get the contract and say, hey, Josh, Joe and Jane Smith, we've got a contract. It's not like I order the appraisal and can send out disclosures immediately. We have to reach out to the closing agent and say, hey, I need all of the third party fees because we as a lender are held responsible for making sure those are disclosed accurately. So usually takes 2 hours to 8 hours. Within 1 day, we get those back. We prepare the disclosures, get them out to you. You're going to want to review them. You're going to have some questions. Once you sign those and we get them back, now I can order the appraisal and charge you. So again, on purchases, 8 times out of 10, 9 times out of 10, I want to just pay for that myself just so we can save that time. But I will also say, If a borrower is sketchy or has shown to be a little aloof or goofy in the past, we're just not in a position to be able to do that. I have a client right now who has canceled 2 transactions prior to this. I'm not paying for any appraisals because they've shown they'll put a property under contract and then cancel. Most purchases close. So in that instance, in trying to save time, we would do that. So the last thing I would say here to Rod says, once it happens and it checks out, you're conditionally approved. Your approval, the appraisal is only an element of that. So your loan may not be approved. It could be, but it doesn't have to be. Your lender, your loan officer has to be getting that file submitted to underwriting so that when the appraisal comes back in and is signed off, that you have a conditional approval. So important to know those two things are different. And then there's actually a third element to this. Approved. Next, when can you lock a rate? You don't need any of that to happen to lock a rate. As soon as we know you have a property, I know you, the borrower, I know your credit scores, and I know the property you're buying, you can lock it at any point. So if someone's telling you, I need X, Y, or Z, generally a red flag, I would ask them, why are you not wanting to lock my rate?
All right. Good stuff. Good stuff. Let's see here. Looking through some other questions, but we're going to go through this.
We have the most important one right here, Jeb. Are we at 5% mortgage rates already? What happened to the beard?
Yeah, so the beard was growing great. I was doing really, I mean, it was like a weed. And my wife looked at me yesterday or the day before, and she was like, I think you need to trim that beard. And said, are you serious? And she said, yes. And my wife has had medical issues over the last week, so she wins. That on top of the fact that I've been sleeping in a chair in the hospital for the last 7-8 nights, actually. And so with bags under my eyes and a beard, I look like Josh, and I didn't want to look that old anymore. And so I thought shaving would look younger, and I was right. And so, we start over. No one wants to look like Josh. So you shave the beard. All right, Josh. Walter says, can my wife buy a second home? She is not on my loan, basically not on title to the house, and looks like maybe buying it for an investment property. So can somebody's wife, can my wife go out and buy a property as a second home or as a primary home, even though she's not on title of my house?
So government loans, FHA, VA, it's a community property state. We have to count the debts of the spouse against you. So if you're going out to use a conventional loan and she's not obligated on that loan, then you should be fine in terms of qualifying. So brief, short, easy answer. But in terms of the context of not asking you 15 more questions, yes, but specifically if she's using a conventional loan. And if she's using FHA or VA financing or attempting to use FHA or VA financing, it can be done, but we're going to have to count the debt for your house against her, which we would not have to do on a conventional loan.
All right, good stuff. Jay says he's buying a new build closing December, got a 5.875 lock. Congrats, Jay. That's awesome. Probably a buy down, I'm assuming, from the builder. Let us know in the comments. I'm interested in hearing a little bit more about the process there. Did you pay full asking for the house and get a buy down, or were you able to get less on the house and the buy down? Just interested. And also, what market are you in? All that's good stuff to know. Josh, Daniel came in and said, thoughts on the Fed's comments today on higher interest rates likely to impact the housing market. Think they mean a seasonal impact this winter or perhaps a more long-term downward trend?
The only part that I saw it was referenced in the Q&A, he was talking about that it is having an impact and referencing the lock-in effect, that people are not selling homes, that we're having a massive decrease in activity. Is it reasonable to think that it would impact over the long haul? It really depends on the level. I think if rates were to stay at or above 8% for a protracted period of time, you would see that start trickling into values. But I didn't hear him. Jeb, did you listen to all of it?
I didn't. I didn't hear anything directly related to that. But one thing I will say, Logan Matashami that we follow from Housing Wire, housing analyst there, one thing he said is that last, October, November, right after the peak in rates, and then you saw the, rates come down and the market pick back up, the Fed more or less signaled that, the recovery was kind of over in housing. And he's, he always references, are you crazy? Like, there's no rebound in housing. Look at the number of transactions happening. Like, the number of transactions is far and below anything that we've seen pretty much ever, historically speaking. And therefore there's no rebound in housing. You're such a low bar out there with regards to the number of houses that are on the market that, yeah, there was some pickup because rates drop, but there's no rebound. Housing is suffering from a sales standpoint. The crash in housing wasn't prices, it was transactions. And the transactions side of things isn't going to improve in any significant way until affordability improves, until rates improve. Simple. We do have another super chat here, Josh, so I'm going to jump to that before we talk about the other questions in here. So $1 billion idea says, can I qualify for a larger loan by investing my money into income producing funds to artificially make my income larger? I have 120,000 liquid, but I only make 50,000 a year and I want to buy a $300,000 house.
I will state that I'm going to answer this with 90% certainty of the accuracy of this. So investing in income producing funds, we need a history of it. We need the capital gains on the tax return.
For how long?
Let's show I had these funds. It's going to come down to the loan type. FHA and VA are going to require 2 years tax returns. Conventional, you may get a 1 year finding. But in terms of that, 1 to 2 years of having capital gains income on there. Now, there are options. Freddie Mac will allow you to annuitize the 120,000 and get some additional income for that. So it could be a possibility, but going out and doing something immediately that going forward starts generating income. It's sort of like getting a second job. A lender won't let you get a second job today and start using that income to qualify. We need to have a history of it. And on the flip side, let's say for the last 2 years you had been investing it, and that 120,000 is bringing in an additional $10,000 a year. If we're using that 120,000 for your down payment, we don't get to use that capital gains income because you're not going to have it to continue generating the income. So hopefully that answers the question for you.
No, that's good. And one thing you have to consider too is once you start getting capital gains income, you're also paying tax on that capital gains income, right? So yeah, you're making more income from income producing assets, if you will, but you're also going to be paying higher taxes on it, which means, it may counter each other in some ways with regards to where that, where's that money coming from that you're going to have to pay taxes on. So good stuff, Josh. Good stuff. So this is an easy one. I mean, because I can't really answer it here, but Sam says, can you outline the home buying process from the initial step to the final step? I mean, I could. It's a long process, probably more than we have here, but just kind of quick summary, very, very quick. You get pre-approved, you find a realtor, vice versa, right? However you want to do that. You go out looking for a home, you find a home, you write an offer, right? From there, offer gets accepted, negotiate different things, appraisal, home inspection, all of that stuff gets completed. There's disclosures, there's some other contingencies that you have to do during that process. At some point, your earnest money deposit is released in that transaction. And, you get to the final steps, a closing disclosure is issued, you sign loan docs, you wire funds, and the thing closes. Now, there's obviously a lot more detail that's missing there, but in lieu of being long-winded on a very short episode here, that's
like someone maybe should have a course explaiing all those steps.
Yeah, so that will lead us into something that's coming here really soon. So with that said,
well, Jeb, here, Sam had a follow-up question that's super easy. Which sites have accurate and relevant information to current fixed and variable mortgage rates? Optimal Blue Mortgage Market Index is one that is very good. Mortgage News Daily also publishes. They're not perfect. They're not going to be detailed and perfect to your situation, but they are accurate, and you can dial in some of that info.
All right. Wow. Let's just go with this one real quick, and then we'll kind of go down to a different style of, just more of a comment, and then kind of elaborate on it a little bit. So ST in Long Beach says, any scenario in which condos increase value more than they have historically. Just bought a condo in Long Beach, California. Yeah. Over the last 3 years, that's exactly what you saw happen, right? Condos, single families increased more than they have historically. Why? Super low interest rates, artificially low interest rates, a lack of supply in the market. Housing affordability improved considerably because of interest rates being low. Therefore, more home buyers, driving up prices, multiple offers, that sort of thing. That's what drove it up. Are you likely to see that anytime soon? No, but you are likely to see prices continue to slowly go sideways to up, in my opinion, until inventory changes. So, and that's not likely to happen anytime soon. Josh, there is a comment here. from Kirsten. It says, I thought I was locked in with my pre-approval rate, but got called yesterday and asking to lock in since I'm closer to a closing date. My rate went up a whole percent. Is it because it's the preferred lender? ? I'm assuming the builder. I don't know. Maybe I'm guessing here. You can tell us, Kirsten. I was at 5.375 with pre-approval, but now 6.49. I'm going to fight to have them match with other offers. So, Kirsten, I'm not sure you have a leg to stand on there. Personally speaking, I don't know the whole scenario here, but chances are they're not going to be able to lock that in at what they originally quoted. But Josh, thoughts on this?
Let's start with the most important thing. Anyone here and listening to that, do not ever think, hope, assume, pray that your loan is locked in. If I lock your loan, we have to issue you a locked loan estimate. So we've talked about the loan estimate on the show. We did a whole episode of the podcast about it. On the top of the first page, it's going to tell you, is it locked? How long is it locked through? So you never have to guess, never have to wonder. If you have not been issued a loan estimate with the box check that says it's locked, you are not locked. We can't lock your loan and not give you that disclosure. So easiest and best way to know if you are locked. In this situation, clearly you weren't, because if they had locked it, they would be honoring that and would be happy because they locked it at a lower rate. So the problem you're going to have, 6.49 is still a spectacularly amazing interest rate. So they didn't lock you. They didn't have a long advance lock. So now what they are doing is buying your rate down to 6.49. We just talked today, what, 7.5, 7.25. So if you're at 6.49, they're still paying through the nose to get you down to 6.49. So Anya had mentioned, hey, reach out to a broker like Josh. Call Josh. Josh is going to go, hey, 6.49, cool, we can do that. It's going to be 4 points. Do you want to pay 4 points? And you're going to say no, and you're going to go back and you take the builder's 4 points to buy that down to 6.49. So depending on the loan type, it may not be that big of a difference, but a conventional loan is way over 7% today. So most likely it's the builder's preferred lender. They didn't lock you in for whatever reason you were led to believe, or you believed you were locked in. And now that is what is the best available in the market. And anyone who is not related to the builder, who is going to receive money from the builder to buy that rate down without charging you, is not going to have a rate that can compare to that.
Good stuff. Let's see here. Excuse me. Sam says, given current rates, what would be the best way to find sellers with 2 to 3% adjustable FHA loans? Also, would this be worth it? Is it worth your time? Difficult question. Could be. I think it's highly unlikely in most cases that you're going to find something like this. And the reason I say this, so we did an episode on the Educated Homebuyer podcast. Again, you can go check that channel, watch the video, listen to the podcast. It's detailed on this sort of thing. We talk about it in detail. And if you haven't gone over there and liked and subscribed, do that, please. It helps us and helps kind of get the word out about the podcast. It's different than this, and it's good stuff. But anyway, let's talk about the issues here that no one seems to talk about. 2 to 3%. Anybody that got a 2 to 3%. Got it in 2021. That's when rates were in the 2 to 3% range. Since 2021, I think it's fair to say, Josh, prices have easily increased 10% nationwide, probably higher in most markets. But let's say 10%, for example. So somebody buys a home for $300,000, hypothetically speaking. That home is now worth $330,000. You're looking for FHA. So that tells me that you're looking for something where you can put 3.5% down to take over that mortgage. Well, guess what? Those people put 3.5% down back in 21. They've probably paid the principal down, I don't know, $10,000, $7,000, $8,000 since they bought the property. Plus they have $30,000 in equity in the property that we talked about a minute ago. So you're going to have to come up with the difference, right, of the down payment versus their equity in order to get them to even take over that loan for the most part, on top of qualifying. And the biggest struggle here is actually finding somebody that would do that, right? So who is going to sell you their home that has a 2 to 3% interest rate in this market that doesn't plan on buying another house? And why? Why are they selling? Can you find these people? Sure. You can get public records. I can get public records. I can tell you everybody that has, an FHA loan that kind of meets this. But the other questions are they in a place that you want to live? Is it a condo? Do you want to live in a condo? Is it a single family home? Oh, it's a single family. It's not really where I want to be. I would never live there. So not only are you weeding through people that have this and are willing to do it, but you also got to find a location that you're willing to be in for an extended period of time. And I think the biggest thing is that you got to have the difference in cash. Like that's what no one's talking about that. Everybody's just thinking about the idea that I want to get the guy that has the 2 to 3% adjustable. Great. Well, his home just appreciated 30% since he bought it. Do you have that cash on hand? If you do, then you probably should be doing an FHA loan to start. But Josh, anything you want to add to that?
No, that's all of it. The comment that I would add. So Jeb just told you all of the reasons why it is very unlikely. It is not impossible. After we did the podcast episode, I had a listener reach out. They own a home in Alaska. They're veterans. They're in Arizona, and they found someone who is willing and able to sell them their their home with VA financing at like 2.25% in Phoenix. They need $42,000, and they're trying to figure out how, with their home in Alaska, any other assets they have, they can scrape up $42,000. So they sounded pretty industrious. It's not going to be easy, but I bet you they will, and they're going to be stoked to get that to whatever interest rate. Mm-hmm. And they had a seller that they found directly. It wasn't listed in the MLS, that was willing to work with them, veteran to veteran, helping one another. And it sounds crazy, but that's the more common thing that I'm hearing. Veterans like to help other veterans, and I'm seeing more of them in the VA space. Sort of the last thing there to close the loop on that, it's important to know if you're not a veteran, you can assume a VA loan. So no problem with that if you have the seller that is willing to do that without getting their entitlement restored. So it is a possibility on a VA as well.
And please do me a favor. If you're in this position and you're thinking you want to go assumable, like Josh said, it's not impossible, but don't go out and pay somebody a website, money, like up front to go and find you one of these deals. Because you're going to be because if you're looking for it, guess how many other people are looking for it, right? And so you got to find an agent, a real estate agent, a professional that can go out and help you do this if that's the goal. In some cases, you can find them on your own. But again, don't pay somebody upfront money to do this. It's like paying, back in the day when people would pay to, have somebody deal with their short sale. Like they would, it's like, no, you don't need to pay. Like it's possible to do this without that, right? There's a lot of people out there willing to help you. So anyway,
Jeb, Kirsten had a follow-up here, and I think it's actually helpful for folks. To be clear, I'm asking if there's some type of time period that you get to lock in your rate. I wanted my rate locked months ago, but the lender, they said that had to wait for a closing date. And followed up here, if you're waiting on new construction, is it possible to lock in the current rate even if the completion date is not clear? Would like to know for the future. Yes, you can lock for 360 days. But not every lender offers those options. The longer you lock, the more the hedging cost is to the lender. So the more expensive or the higher above the market that interest rate is going to be. It sounds like you're absolutely with the builder's lender, not just their preferred lender, a lender that they own because they're paying all of that money to get you that lower interest rate, and they do not offer them. Because I can tell you, every builder's lender that I know that does have those long extended locks and was buying these forward commitments, they were trying to get everyone as they could locked on the longer locks, because builders don't want things falling out because rates get worse at the end. So the builders that own these subsidiary lenders were paying for those long locks to make sure they didn't have fallout coming at the end. And then Jeb Kirsten actually followed up here with, thanks guys, you definitely explain things clearer than my loan officer. Like, this is one of my biggest pet peeves in the world, is I hear stuff like this all the time from people that I've talked to that will call back late in the game and they'll go, wow, I went with this guy, he had a really low interest rate. I liked my conversations with you, but he quoted me a really good rate. And now nothing has gone right. They dropped the ball. We couldn't do this loan. We're going to another situation. We talk all the time. It is important that you get a competitive rate and low fees. But when you make 50 phone calls and your goal is to get the lowest rate, you will find yourself in a situation where you are with a low rent loan officer. You get what you pay for. A low rent realtor. And this is obviously not Kirsten's situation. He didn't have the choice. The builder says, hey, here's my loan officer. Go talk to him. But I'm saying,
but you do have a choice. You do have a choice. You can talk to their lender and still go talk to somebody else. Now, with that, the builder might be offering incentives for rates and that sort of thing that you just can't compete with. But that doesn't mean you have to go with anyone. Just to be clear. So
when you make price your buying decision, I'm going to go with the lowest price someone will quote. You will get what you deserve.
All right, good stuff, or not really good stuff, but Appreciate the answer. Marcus is asking, how far back do you go for comps to determine if a listing price is a good deal? So typically what an appraiser will do is they'll go back 6 months, 180 days. I think most appraisers like to use 90 days as much as possible, right? Because it shows a better idea of recent trends in the market. In the market that we're in right now, I think the last 60 days, you got to go back when are rates high, right? Like if 8% rates have been the norm for the last 6 months, then use 6 months. If 8% rates have been the norm for 30 days, then you really want to use something that's closing around, right when you're buying, like somebody that has similar rates, because rates affect prices. They do. Now, it's going to be difficult to do that, but you try to find something as comparable as possible. Size wise, bedroom, bathroom count, similar neighborhood, similar location, style, condition, all of that stuff in a similar market. So the market's changing, over the last 6 months or so, Josh, 5 months, but we've kind of been in this high 7.5% range for a while. So I think the last 30 days, 45 days is probably pretty good.
And Jeb, talk about this. So you as a realtor or an appraiser, what's the difference between you here in Orange County, where we have lots of tract homes, similar homes, many comps to choose from, and someone out in rural Nebraska trying to appraise a property where there's one?
I don't know, quite frankly, how they do that. So I've only done real estate here in Southern California, right? Similar, a lot of similar style homes, tracts built, that have similar style properties. Not a lot of customization in properties in our market. Once you get the luxury space and that sort of thing, you get some custom homes. So it's pretty easy for the most part to go find properties of similar size, square foot, location, all of that stuff to be able to base numbers off of. It's a little bit easier. You get out in rural areas where, somebody's sitting on 5 acres and the next house is, 10 miles away and they got a farm and a horse stable. It's just like, it's difficult, right? I mean, you try to always find as close to what you have, as close to the subject as possible when you're doing this sort of thing. And sometimes you have to go outside of radiuses in order to find it, and outside of time frames, and adjust for market conditions and that sort of thing in those areas. But that's where my knowledge of rural appraisals ends. I find that very difficult. I've actually thought about that as a real estate agent, as an appraiser, how difficult it would be to comp some of these properties out, just because nothing like it.
They get a ton more leeway, like you said, both in time, how far they can go back, and distance. But it becomes more of an art than a science when there's less comps relative to what we have in denser areas.
Good. Gil has a question, says, my fiance and I are working on building our credit to buy our first home. I've heard things regarding, child support debt and how it affects my ability to buy a home. What do you say, Josh? So things that show up on your credit report, student loans, credit cards, car payments, that sort of thing affect your debt to income ratio. But in addition to that, alimony, child support, those things do affect your ability to qualify because they go against your debts, right? Go against your income, rather.
So yes. Gil followed up, $30,000 debt, but monthly payment is $200. For the most part, the amount of the debt does not matter. It will impact your credit score. So, and especially when you're saying there's an amount of the debt, that tells me that there's back child support, and oftentimes that will show up on the credit report. So, from that perspective, it may be having some impact in the credit scores there, but really we're just looking at the $200 a month and going through your debt to income ratio. It's no different than if you had a $200 car payment.
But doesn't the amount matter, Josh, in the sense that if it's going to end in less than 2 years or 12 months, is it 12 months?
Yeah.
So say you owe $1,000 and it's $200 a month, that's going to be paid off in less than a year. Therefore, it's no longer part of the debt to income, or it still is.
It can be excluded, but it is underwriter's discretion. So let's say you had a $10,000 a month bill and it had 7 months left to go. And so you have $70,000 owed. An underwriter could look at that and go, no, this is a problem. You cannot afford that payment until this thing is paid off, or you need to pay it off now. That is incredibly rare and an extreme example, but it is up to the underwriter's discretion. They would never do that with a $200 bill that's going to be paid off in 4 or 5 months. But with a big one, $1,500, $2,500 a month, it can give them pause.
All right. Good stuff. You know, it's 5:53. I haven't asked all night for you guys to hit that like and subscribe button. So if you're listening now, there's 135 of you watching. If you would hit the like, hit the subscribe if you find any value here at all. If you're watching from the Educated Homebuyer channel, go over to Jeb Smith and do the same, and vice versa. And if you're not listening to the Educated Homebuyer on Spotify, if you're a podcast listener, really good information. Josh and I go deep into topics, really, kind of take it next level with regards to breaking things down, like almost like layman's terms, like anybody can understand what we're talking about. Because really we want, the education part to be the most important key there. And if you want to talk to Josh and I, get a referral, pre-approval, looking to search for real estate anywhere in the country, you can reach us using that referral link that's, scrolling across the bottom there. So Josh, I got that out of the way. This is a question that a lot of people have, and people truly don't understand how much this actually costs. So how much would it cost to buy a rate down from 8% to 5%? So that's 3% on an $850,000 home. So that's 1% of that purchase price is $8,500. Okay. So credit score, great. Saying 10% down, that's irrelevant here. So what are we talking about, Josh? What are we looking at?
Here, the credit score and the down are relevant only to this extent. At 10% down, you don't have exorbitant loan level price adjustments like if you're doing 3% down. At 780, you don't have a big loan level price adjustment for a lower FICO. So we're already starting from a better spot. But in terms of truly just buying the interest rate down, in a normal market, our rule of thumb is 1.1% of your loan amount. That $8,500 Jeb's talking about will get you 0.25% lower. So if you want to go 1% lower,
so
we're
go from 12%.
8 to 7 would be 4 points or $34,000. So now we triple that, it would be about $100,000. But here's the fun part. The further you get away from the par rate, the rate that the lender wants. So if we're saying in this example, 8%, the further you get away from it, the more expensive it's going to be. So the reality is no one's offering 5% fixed rates on a Fannie Freddie product right now, just because there's no way to make it compliant. There's no one that would do it. There's no market for it. No one's going to come up with $100,000 to buy that rate down 3%.
Good stuff. Yeah, no, that's tough. That's really, really tough. We can talk about this one, Josh. This is pretty easy.
I'm so happy you hit that, because I just ask the question and let me answer. I have something important to say.
I'm in contact with a real estate agent suggesting doing a 3-2-1 buy down. When is it beneficial to do a 3-2-1 buy down?
We're going to answer that question, but Jeb, how often when someone calls do you start suggesting loan programs to them?
Rarely ever, but I will say there's a lot of influencers out there at the moment that know loan programs now, and they're suggesting that we talk about 3-2-1 buy down. So there you go.
Yeah. A realtor needs to stay in their lane. A loan officer needs to stay in their lane. Like both of, I have a lot of real estate information, but I don't sell houses every day like Jeb does. Jeb has a lot of mortgage knowledge, but he doesn't do loans every day like I do. So for the most part, we need to stay out of each other's business and let us go down that path. And most realtors that I know, most of the productive realtors say, hey, I don't want to know. Finish the pre-approval. Tell me what the best loan is and tell me what they're pre-approved for. And I'm going to go find them the best house and do the best negotiation for them. So a 3-2-1 buy down is 3% lower the first year, 2% lower the second year, and 1% lower.
Ooh, that sounds nice. Is it costly?
Awesome. Is it free? No, it costs more than 3 points. It's almost 4 points to pay for that, depending on what type of loan amount and where interest rates are on a given day. So someone has to pay for that. Seller, we can ask them to pay it. Well, we have very limited inventory. Most sellers have enough offers that they don't have to do that. If you're in a lower market where the sellers are saying, I got to make these deals happen, is that beneficial? Could be, but they'd also probably take 3.5% less for their house that you could get a lower price. The benefit of a temporary buy down, so this is temporary, it only lasts for 3 years, is truly all they're doing is they're taking that money and they're setting that in an impound account for you, and the lender is subsidizing the monthly payment every month. Your payment is not actually any less.
So let me explain that. So a seller, in this case, Josh said 4% to buy down the rate in that case. So let's just hypothetically use a $500,000 purchase price. So that seller, in this case, is giving you $20,000 to buy down the rate, which again goes into an impound account, and pays down the difference in the payment. So you're not actually, there's no difference in the payment. It's that money that was given to you is buying down that payment. Okay. Here's the deal. If you believe rates are going lower at some point in the future, you're better off to get the property for 480, in my opinion, take the higher rate and refinance at some point in the future. Now, that doesn't mean tomorrow. It doesn't mean next week. Doesn't mean later. It just, there's an opportunity there, because once the money's gone, guess what? Your rate is back up to market rate, within 3 years. And then that's your rate. So, it's a quick subsidizing of the rate, but it's not the answer. Everybody just thinks that, they don't understand you're paying for it. Like, that's the money is actually paying down the rate, the difference in the payment.
So Jeb, a good piece of it is, let's say in 6 months, rates are 2% lower and you go, geez, I want to refinance. That money is still sitting in that account and it will be credited to you. But is this necessary? Is this beneficial? Is this the best way to go about it? Does it unnecessarily confuse and complicate things and negotiations with the seller? I've talked to hundreds of people about buy downs. I have done a grand total of 0 of them. 0. I got to get in the camera here. 0. Because most people look at it and go, no, I'd rather not. We have a listener to the show here that has been looking since last fall, that we actually just closed last month. And they looked at it and we went through it. And he says, he was looking at paying for the buy down himself. And he looked at it and goes, no, I'll just leave the money in my bank account. I can subsidize it myself. And that's the right decision. With where rates are at right now, we're going to be looking at refinancing.
It's the same thing. If you're paying for it, especially if you're paying for it yourself, it's the same thing. You're either paying it to the lender or you're paying it every month. There's no difference. It just looks better on paper. Anyway, that's an hour, guys. My son posted up on my mother-in-law's account here. But anyway, says, good job. He thinks we did a good job tonight, Josh. So that's a step in the right direction.
I appreciate the support.
That is positive. But here's what I would say, guys. The market is going to be slow for the foreseeable future in the number of transactions. Rates are high, not a lot of inventory. You're heading into a seasonal time in the year where things are going to slow down even further. So buckle up, work on the things you can control, your credit, your down payment. If you're in a position to buy, you find the right home, fantastic. But the world's not crashing. The world's not ending. I learned over the last week that none of this shit really matters, quite frankly. None of it. Absolutely 0 of it really matters. So focus on the controllables and let the rest take care of itself. Yeah, that's all I got,
Agreed.
Josh.
Agreed. No, 100%. If you're healthy and your loved ones are healthy and you're happy, everything else will take care of itself. And some of the stuff I don't know if you want to go through many more questions, Jeb, but we had a couple different ones here. Should I buy now? Should I wait? I live with my parents. Like, here's the thing. Very difficult for someone else to tell you whether you should buy now or wait. Yep. But what I will say, if you're here, you're interested and you want to become a buyer, do the things that will enable you to successfully become a homeowner when you decide that the time is right. Save money, maximize your credit, work on career advancement, get in a stable relationship or get out of an unstable relationship, figure out where you want to be geographically, whether that means where you're at right now, moving to a lower cost of living area, moving to a more geographically desirable area. Do the things that will make you a successful homeowner. And when the time comes that it is right for you, you'll know. If you're feeling, I'm not sure, there's no need in the current market to force things and push it. Just wait for it to come to you, but educate yourself, empower yourself, work on becoming the person who can be a successful homeowner when the time's right for you.
Awesome. So I'd probably keep it going a little bit, but guys, I'm exhausted. I need rest. And so that's it for tonight. We'll be back next Wednesday, hopefully with lower interest rates. But in the meantime, we'll go with the educated home buyer slogan: buy right, borrow smart, build wealth. Until next time, au revoir.
All right.